Drennan, are you seeing these annotation requests? Annotate the shared content. I'm going to do the same with that one. I apologize. Anyway, so we'll get back to slides. I think that my bio came out with this. Everybody has kind of understands my background. What I like to lead with here is that I don't manage money, form money right now. And what that means is I'm not soliciting clients or managing anyone's money at this point. I'm not looking to profit from this. This is just something I put together based on years of being in both the tax industry and some time I spent as a VP in wealth management for PNC. There were some things that I thought were fundamental, and they're smattered throughout different books. You'll find pieces of these, but I tried to present them in a clear format without a lot of hyperbole. And one of the things we'll get to later is just how some of these things are packaged. But you know, I called it, I'm calling it now The Truth About Money, essentially because I want to take care of some of these industry idols. I want to identify some of these critical realities. And I want everyone on this call to understand that if you're in law school, you're smart enough to understand money management. And a lot of the things that are used to sell money management as a product are designed to make it more confusing than it needs to be for a good 90 to 95% of it. One thing I will say for the record here, I'm not going to talk about investments. We're going to talk about some math about fees, but I'm not going to get into any specific investment vehicles here because that's not the topic of this. And I am not a licensed RIA, so we're not going to talk about investing. We're going to talk about pretty much personal accounting. So with that said, we'll go ahead and get started. There we go. This is my opening slide. This is one of my favorite quotes. This quote kind of really changed how I think about money when I heard it. Unfortunately, the scene in which he says it is vulgar in some places, but this quote that comes out of it is, own your house, have a couple bucks in the bank, don't drink. That's all I had to say to anybody on any social level. It really kind of struck me because as a part of this, he starts talking about what I'll call walk-away money and what it means. And his definition of it, well, as I said, was an R-rated movie. It really kind of resonated with me. It wasn't a Rolls Royce. It wasn't a Porsche. It wasn't an $8 million house. It was your concept of when you were able to tell somebody that, you weren't going to do something you didn't want to do, whether it's a job or something like that. It was a concept of freedom that I'd never heard phrased that way before. And so I wanted to open with this quote here. Isn't all of this obvious? Charlie Munger is one of my favorite authors and speakers. And for those of you who don't know, he's Warren Buffett's partner and I think probably best friend. One of the things he said was, you recognized early on that very smart people do very dumb things and wanted to know why and who so we could avoid them. And I think that is a critical concept here in that money, like a number of other things in life, has an emotional component to it. And people make some foolish decisions even though they're very smart people. And one of the things I want to get into as we go on here is that you've got to view this in the same way that you would view a case for one of your clients. You have to view it dispassionately and look at the facts and understand that there's tools to be applied and apply the appropriate tools. And I'll touch on a little bit later of some highly regarded leaders who had money troubles. And I think too many times in this culture, we try to assign a moral failure to the inability to manage money. And I think that's wrong. And again, that's one of the undertones here is that you want to take a step back, understand that we have this emotional component, but deal with it in a way that's similar to what you're being trained to do now. I mean, you're going to have to deal with clients who are involved in situations that are very personal to them. And you're going to need to be the dispassionate observer and the one that gives them the information that helps them make the best decision. And I want to empower you to do that for yourselves. So these are the major assumptions about money. First one is the 401k assumption. Save enough to get the full company match if one is available and you can retire at some level of comfort. Expert assumption. Employ money managers and use mutual funds and products with significant fees that only experts understand to get a return that's higher than the market return from an index fund. The debt assumption. Use consumer debt products to acquire assets such as houses and cars on which less money is paid in interest than you earn in your investments. And finally, what I like to call the contra Mr. Scotty assumption, personal money management and business money management are different. The laws of physics do not apply to the former in the same way as the latter. Now, I can't see all of you, and I can't hear all of you, and this is the first time I've done this, so I never know. I normally like to look at the room and see how many people got this joke and remember that at one point, Mr. Scott, you know, well, I guess at one point, he will frequently declare, I cannot change the laws of physics, Captain. Well, you can't change the laws of physics here. And it all comes down to the physics of cash, which now I'm thinking about, it's kind of a catchy way to look at it. It doesn't change whether it's a business or whether it's your personal financial life. It's essentially the same, and we're going to get into how that works. Jim Wendler, you're being lied to. This is a quote that he uses. He's actually I don't know if he's a champion powerlifter, but he's an extremely good competitive powerlifter. I believe he squatted somewhere close to 1,000 pounds, and he put out a book called 531, and he's just a tremendous writer. It always struck me. I always liked this quote because that's how he opened a lot of when he talked about his philosophy. Is a lot of the fluff that surrounds lifting and working out is, you know, you're being lied to line other people's pockets. So I'm repeating the similar theme a few times. I'm going to climb off this soapbox so as to not dilute the content. So first, unfortunately, it's unlikely that contributing the minimum necessary to your 401k to get the match is going to enable you to retire comfortably in 30 years. If you invest 6% pre-tax of $114,000 salary for 30 years, and let that kind of sink in. Think about the parameters that I've plugged in here. It yields about $1.38 million, assuming a 7% cumulative return, annual salary increases of 3%, and an employer match of 50% up to 6%. Now, $1.38 million sounds good until you start to figure out, well, how do I live off of that? And then you realize that your withdrawal rate at 4%. Now, there's some people that can argue with me about whether 4% is an appropriate withdrawal rate. There's a lot of articles on going one way or the other. I'm using it just as the easiest benchmark. I'm one of these geeks who will have a discussion about that ad nauseum with whomever, just because I find it a fascinating concept. It only gives you $55,200. That's a pre-tax, pre-inflation $55,200. And again, this is normally where I look at the room and try to figure out if everybody's tracking with me. But at the risk of overemphasizing, you're going to be able to take out $55,000. You were making $114,000. There's a significant. I'm sorry, I just saw a note come up. Can everybody else still hear me? Andrew, are you still able to hear me?
Yes, I can hear you, Dan. Just fine.
Okay. Sorry. Okay. All right, good. Looks like it came back here. I apologize.
Everyone can hear you.
Yes, this is good. I like this. I am getting a little bit of feedback, so I feel and I'm not speaking into a void. You know, it sounded my voice rambling on, putting people to sleep. Anyway, so the next slide. Unfortunately, and again, this is a statistical analysis that's been done multiple times. You aren't likely to beat the market return, even with a professional money manager. There's studies all over the place, mainly because, you know, everybody likes to play with statistics and try to support their position. So the studies vary from 49 to 0.06 of active managers who can beat the market, percentage of managers who can. But you have to pick the right one. I always make this analogy, and it's not really an analogy. This is the way I explain it. So there's me sitting there with the money that I want to invest. And then there is the person who I'm going to pay who's going to be my financial advisor. And financial advisors most of the time don't manage the money on their own. They use a basket of funds. Now, when they do that, if they're going out and picking another manager then I have this double level of risk. First, I had to be smart enough to pick the right financial manager. Second, they had to be smart enough to pick somebody who was going to manage the money. And on top of that, I get market risk on top. So I've got 3 different risks there. And there's someone might disagree with me on how I view that, but I really believe it's critical that I don't want to add risk here. I've already got market risk. I don't want to add manager risk in a lot of ways. And that is one of those things that your mileage may vary, and I'd encourage you to talk to your accountant and, CFA or CPA PFS about that in an individual circumstance, but that's just my opinion. That's the way I look at it. And I'd like you to look at it because, again, as attorneys, we're risk managers. What does the risk profile look like? In this case, I've got an expanded risk profile when I'm picking a manager who's picking other managers. So the other thing to note is that the standard fee structure is about 1.2% in fees. That's about $12,000 a year that comes out of your savings or comes out of the income. That's very significant. And over time, that deduction tends to add up. So keep in mind that, and there are articles that I'm going to try to come up with a document or something we can put out there that has links to a lot of the articles about the things we're going to talk about. But mainly here, this amount that comes out of your savings, that you're paying for somebody to manage your money is significant, and over time erodes your returns. Debt. This is a position that you're going to ask me, well, geez, Dan, I mean, you're channeling my grandmother or my grandfather here. Come on, get with the times. The reality in my mind is debt is never in fashion. Debt is money that costs money to use. You want to use as sparingly as possible, as cash flow is king, and a restricted cash flow is what sets the table for failure. Amazon has done this just devilish thing now if you have an Amazon credit card, where you can go in and you find this thing that you're teetering on the edge of being able to pay for. Like this, I was looking at a monitor yesterday, and it's like $500. And right underneath it says, buy this and only pay $53 or something. I can't remember what it was for the next 6 months or 12 months. I'm like, that's a very attractive offer. That's a 0% loan. And I won't do it because even if I say I'm just going to do it on this one thing, I get the feeling that these are stacking on top of them and people are forgetting how many of these things they've done this with. And so it's, even at 0%, you're still paying for something over time, and you got the stuff that you don't fully own, whereas before on Amazon you had to pay for everything outright. It's very interesting. I'm wondering what their sales profile. I wish I could find out what their sales profiles look like for people who are buying using that method. I'm betting they're going to get a significant bump there. But back to kind of the concept here. You have a $100,000 mortgage and you pay 3.13%. I'm actually not sure if that's a good market rate, but I think that's fairly reasonable in most markets for 30 years. That's going to cost you $54,000 over that time period. That's a huge amount. I mean, that is a cumulative 54% that you've paid on $100,000. So I really, even especially now with the change in the tax law, especially at the housing level, which we'll get to, I really, debt costs money, and in the end, it can really have a significant effect on your ability to manage your financial future. I like this quote from Buffett. I've seen more people fail because of liquor and leverage being borrowed money. You don't really need much leverage in this world. I don't know that I agree with that second statement. I think you have to be careful about it. But, if you're smart, you can do a lot of what you need to do without borrowing. Now, student loan debt's another thing we're going to get into. So let's just kind of put that in its own box and set it aside for a moment. Okay. Here's the deal. A successful financial life requires that you manage your life like a business as much as possible, so that sometimes on the things that matter more than money, you can be human. I did tax returns for a lot of extremely wealthy people, and that was very fascinating to me, and I can't talk about the specifics because it's federal law. But one thing I did get from them was they never looked anything like any media or even kind of, let's say, mythological concept of a wealthy person. You'd see somebody who was making millions of dollars every year who was driving a used Toyota Highlander. I found it fascinating for these people who were so successful to see, what really mattered to them. Some of these people were just making financial contributions without really being concerned as to whether they could deduct them to support causes that they believed in. And it was very fascinating to me to see that. And so what I mean here is you kind of have to build some anti-fragility in your life. Eventually, you're going to have to, houses are a good example. Houses are something that in some cases, it's really hard to get a good deal on a good piece of real estate. And you're going to feel like you paid more than you should have or you wanted to. Of course, we want to avoid that. But at the same time, it may be something that, you can't manage the timing, you can't manage the deal because of other things going on in your life as well as you'd like to, but you want to give yourself the ability to absorb that. And you want to give yourself the ability to have some fun. This really is drudgery if you can't prioritize. And that's the other thing I learned from my time doing those returns is that there are people who were well off would set their priorities and save for certain things so that they could splurge on what would appear to be luxuries, but they figured out where they could sacrifice, where it really didn't mean that much to reduce or spend less. And that's kind of where I want to guide you to is figure out where you can save and figure out where you, for lack of a better term, get the most bang for your buck here. Money like food's hard to optimize. One of the things I tend to throw out here is I'm one of these people who thinks I've tried to optimize things for a long time. So that optimizing is one of those things where you're trying to make sure you're spending every dollar appropriately, and at each point in the month you have a certain amount left. And the problem is the magnitude of expenditures such as breaks, blowouts, tire blowouts, repairing your furnace, paying for all of those appliances I've had to buy this year that I took for granted. They come in bunches and they're very expensive. So you can't. It's very hard to optimize. And the reason I use the food example is that I've struggled myself with maintaining a healthy weight. And at one point, I was well over 400 pounds, and I found that I can't be one of those people, at least for my psyche. And your mileage may vary. You may be a very disciplined person, but for me, I needed to build up reserves. So if I knew I'm going to go out this weekend, I'm going to be careful in the days leading up to it. So I believe money's the same way. You try to optimize as much as possible, but you really have to leave yourself some good margins of safety because big things are going to happen and they're going to come out of nowhere. And you can't you can't be, dollar for dollar or calorie for calorie on the money every time. It's just too hard with human behavior. I'm hoping I'm not losing everybody with this. I'm getting a little in the weeds with the psychology here. If I am, let me know. Seek robustness over optimization. We talked a little bit about that. So, okay, so this is going to hurt. Jack Nicholson. I like to throw this quote in here. So let's get into the interesting stuff. Let's say you actually get a $100,000 salary, and I'm saying that's what's on your offer letter. What does that lifestyle look like? Gross salary, $100,000. Here are the assumptions. Single filing status, no itemized deduction, standard deduction. Pre-tax 401k contribution of 6%. National average health insurance cost of $320 per month. Does not include the deductible or out-of-pocket maximum. We're going to talk about that later. It's going to leave approximately and charitably, after all estimated taxes, about $64,893.78. That's about $5,407 a month. This is actually high based on other calculators I've used, but that's okay. You'll see why high is okay as we go along here. All right, first thing you're going to do is your student loans. I'm going to call 6.7% for 10 years, assuming $150,000 average debt for lawyers. It's going to be about $1,726. One-bedroom apartment. Now, again, remember, on the student loans, if I back up here, the longer you have those, the more money you pay on them. So we're going to assume that if you get a good salary, you're going to want to take a good whack at those to try to get them reduced so you're paying less over time. on the whole. One-bedroom apartment, assume all utilities included, $1,300. Normally, I get laughs when I say this because it really depends on where you are. In Pittsburgh, you can do that. You're going to buy a BMW because everybody's going to buy. I mean, you're a lawyer now. You got to look like a lawyer. You're going to buy that BMW 4 Series. Yeah, Michelle just not in the Bay Area. Absolutely not. Which, again, remember, this is the big benefit of the doubt. 4 Series is going to be $831. You're going to get all-wheel drive because let's say you live where there's snow and there's nothing more useless than getting to work than a rear-wheel drive car. At least in my experience, your mileage may vary. I picked the cheapest option package because you don't really want it bare bones at 2.89 financing for 60 months. Car and renter's insurance. Car and renter's insurance, I'm sorry, it just said we lost connection there for a second. Andrew, you still hear me okay?
I can hear you fine, Dan.
Okay, good. Car and renter's insurance, $222. So your average, what did I do this here? This math doesn't add up. Let me look at this here. 4 Series average is about $238 per month. Oh, that's what it is. Okay. I knocked this down a little bit. So that's your car and your renter's insurance. And if you don't have renter's insurance, you want to get that because if somebody breaks into your apartment, that's what protects you, at least on a material level. Groceries, $300. This is just under the average for a single person. And what's going to happen is with a $2,500 billable hour requirement, you're going to wander into a grocery store hungry. And I applaud those people who like to do a lot of meal prep. I did it this weekend. I found it exhausting. I admire people who have that kind of discipline. I know we have a few brothers and sisters who I see on Facebook who do, and I envy them. But I'm going to tell you, if you're trying to make that billable hour requirement, you're probably in the office on Sundays, and you're not really going to have time to make those nutritious lunches that you would like to. So I'm putting it $300 and leave it at the average. Continue. Gas is $120, $30 a week. That's kind of a relative thing. You could take that and apply that in some fashion to public transportation or something like that. In Pittsburgh, I think there's areas similar to Pittsburgh where there's kind of an urban sprawl. That's about, I pay about $40 a week, but I have a long commute, so that average is in there. Starbucks, as I like to call it, attorney jet fuel. I had another little less politically correct term, but we'll call it that. $120 a day. That's $4 a day. And yes, you're going to drink it on the weekends. Lunch is $125. That's $4 a day. That is intentionally set low. I don't think anybody's going to eat lunch for $4 a day out. So again, I'm taking low figures here to try to show you just how far the salary goes. Entertainment's $300. That's $75 a weekend. They used to have a deal that was I think it was Applebee's. It was a 2 for something. I can't remember. I used to joke that, at $75, that's pretty much how your dates are going to look. Cell phone, $100 because we're lawyers. We'd never use a work cell phone as a personal cell phone, right? Because we understand just how far discovery goes. Dry cleaning. You're not going to have time to iron, and Armani is not machine washable. So your total expense is $52.45. Profit, I call it. You can call it whatever you like. I call it the profit for that month, $162.81. Slow down. What are our additional assumptions? I know, more good news. We're assuming you're not paying off any credit card debt, you have no gym membership, you're not saving for a down payment on a house, no savings for a vacation, no birthday gifts, no new clothes or shoes are purchased. I know, I mentioned Armani suits. It was a terrible bait and switch. No new tablets, computers, or phones are purchased, and I said cheap dates, but 2 for 1 night cheap, not Happy Meal cheap. It's a step up there. And this one, critical. No accrual is made for your deductibles and out-of-pocket maximums for health insurance. And I'm telling you, that is one that is going to whipsaw you if it hasn't already. A lot of the cost of health insurance plans are going up, and the deductibles and out-of-pocket maximums are also going up. It is, in some cases, you're looking at several $1,000s worth of a deductible which is really a kind of trending back, although I some wish it would go back this direction, but with the regulations, I'm not sure it will, to basically a catastrophic injury policy. So you're paying for every bit of your health coverage up until you meet that deductible. And then you're paying normally 80 or 90% up to your out-of-pocket maximum. So that's 80 to 90% of what the costs that are passed on to you are. And that can be up to, in some cases, $15,000, $16,000. There is a significant issue here if you're not escrowing. And when I say escrow, I mean setting aside. I set up personal escrow accounts for things that are annual or quarterly expenses or large items like this, so I don't get blindsided. You need to be setting these. I'm sorry, I just did a time check at a really inopportune time. You need to be setting these things up for yourself, because when they come, they can really, really cause problems. And let's say you set aside whatever your deductible is for that year, $2,400 or something, and you don't spend it. Again, I'm setting aside HSAs or other tax advantage plans. Well, you got $2,400 at the end of the year you didn't spend. That doesn't put you in a bad position. So taking these proactive measures to try to escrow these costs is only going to benefit you in the end. But this one is, this was a major contributor to financial difficulties in the United States right now. And now the big close. Usually this is the point where most financial gurus tell you that all will be okay because they have a foolproof 100% guaranteed system for generating more wealth than you have ever dreamed of for the comfort of your own home by spending just minutes a day in your underwear. And this is supposed to be one of those PowerPoint slides that's supposed to phase in, because you're not supposed to get the punchline immediately, which is it all depends on how you look in your underwear. I know, groans across the room. I got it. I'm with you. It's a terrible joke. The fact is there's no guaranteed system for creating wealth, but there are some best practices that you must implement for a shot at retirement. And one of those major themes we're going to harp on and cover right now is we've got to implement systems rather than focusing on goals. And the reason I say that is there's been a very interesting discussion about, if you have a goal, were you a failure before you reached it? And are you a failure after you've reached it until you reach your next goal? I don't like to phrase things like that. I like to come up with systems that support, broader themes. And I know that seems like, well, you're splitting hairs there. I don't think that in the world we live in right now, you can put a specific number on what you want to retire at. You might be able to. I mean, heck, I could peg it at $250 million and probably be right. But overall, it's got to be a system of optimizing our financial life with certain rules such that we maximize the chances of being able to retire or retire early or take advantage of things like opening a business or buying a business or things like that. And I think that's how you have to look at it. I don't like you, Dan. I know. At this point, you want to throw something at me, and that's okay. The unavoidable truth is for a chance, and notice I didn't say guarantee at retirement, you've got to work toward the 80-20 rule. You got to spend 20% less than you make, and you got to save that 20% in various ways. The 80% you live on includes reserves for the things you want and emergencies and expenses. That 80% is all in. That 20% gets squirreled away, and you don't see it again until you retire, essentially. Unfortunately, there's no fancy math to save us, no creative accounting that lets you skirt this rule. And this is where I joke about the you cannot change the laws of physics, the Scotty rule. Accounting for your life. Now, Nassim Taleb says all large businesses are insolvent. It's a question of whether they know it or not. That one will give you chills if you work for large companies. It's a scary statement. It seems bold, but if you've seen just how difficult it is to operate a financially solvent large company, it rings with some truth. First thing you're going to do is create personal financial statements, both income and balance sheets. I know it's ugly, but no one needs to know but you. And to harp on a theme here, if you are critically honest with no one else, you have to be honest with yourself. And this is one of those places where you can lie to yourself, and in the end, you'll have all the excuses that you want, but you still won't have the things or the money that you need. So this is a place where you have to be honest, but you only have to really be honest with yourself. Collect, and please remember to pay. I just throw that qualifier in there because I'm afraid somebody won't do that and come back and say, you told me to collect them. I said, yes, but for different reasons. A scan of your bills and other debt service notices, and I'm just using that as a broad term for anybody you owe money to, in a file for a quarter, or at least a year if possible. This is an ongoing process. You've got to update this as you go. I look at this every quarter. So I set up a spreadsheet a long time ago that shows all of my reoccurring expenses. And then I add to that my accruals or my escrows, which are the things like the health insurance, car insurance, things that I know they're going to hit, not on a monthly basis, but on an annual basis. And things change over time. Unfortunately, I've found that things just get more expensive, so your escrow goes up. So it's important to do that, and it's very easy to do. You just use a Excel, and you just set it up by line item, and you sum it, and you have your file here where you have your recurring expenses, and you just use that as a basis for your what becomes your monthly budget, and then you know how much you need to set aside. Because I think I get to this later. If I do, I'll skip over it. But I'm a big fan of kind of a positive thought process. And I don't mean positive and yay, everything will be beautiful and we'll all be millionaires. That's not what I'm talking about. I'm talking about instead of saying what you can't spend, say what you can spend. So if your monthly expenses are $1,800 and you make $3,000, you can spend $1,200. I'm not saying you should, but you can and still account for your expenses and all the important things. And I like to look at it that way. What do I have that I can spend rather than what can't I spend? I can't spend this $1,900. It's just, or $1,800. I can't remember what I said. But I can't spend that. That doesn't work. It's just it's a weird mental trick for me. It's best if you just get that money out of your account immediately, transfer it to the checking account you're going to pay your bills from. And I think David Bach wrote a book about something similar, so I don't want to claim to have come up with that. But it's an important concept. If you don't see it, you're not going to think about it. Track your day-to-day expenses. There are great programs out there for tracking expenses. They're really easy. I use one called Daily Expense, and there's another one. I'll have to see if I can put links to this up that I've used in the past that works. It's kind of difficult, but it's much better than the 3x5 card I used to use where I wrote stuff down. It'll show you, your expenses for the month, and you can track every time you whip out a credit card or pay a bill. You track it, and you'll start to see where your money's going. If you haven't done that, man, it's critical because if you don't know where essentially you're hemorrhaging money, you're not going to be able to take a good shot at fixing it. So I think this is critical. Use cash. Yeah, I think there's another thing. Some people say, well, can you just use one credit card and track it? Yeah, you can. But you got to pay it off that month. I don't encourage that. I would say use cash as much as possible. That way you don't incur additional debt. But to a certain extent, if that's the only way to do it, it's better than no data, as long as you're not building up debt. Now, what about cash back cards? This is an interesting phenomenon because until recently, you were actually getting more money back on the money that you spend than the money that you saved, which is very strange to me. Just from a conceptual standpoint, because you would think, well, banks want to pay you to loan them money, essentially, in the banking theory. Why is it nobody's paying interest on cash? Isn't it good to have cash? Well, banks are trying to encourage people to spend, so they were giving you 3, 5, some percentage back. Your mileage is going to vary. You've got to determine for yourself whether you're one of those people who can remain disciplined. I think it's likely that it's less likely that it's a good idea to chase that cash back, but if you're disciplined, it might be a good thing to look at. So I don't want to rule them out. And of course, there's other rewards cards, but they're all kind of targeted at certain desires, airline miles, something like that, if you want to travel a lot. So, all right. Each month do a cash flow analysis. We kind of touched on that. Again, the goal is have more money than months left. I think that's a Dave Ramseyism. Again, I'm trying to give as much credit as I can here. Just a lot, like I said, a lot of this stuff is kind of central to a lot of different theories. Create reserves. We talked a little bit about that. Negative budgeting. That's what I call I have $3,000. I have $1,800 in expenses. I can spend $1,200. Negative budgeting. I mean, just get the money out. And so you don't see it. Create an emergency fund. The question is when. Again, your mileage is going to vary on this. This is an individual determination. I feel like it's important to build that up from the beginning because you just don't know, when you're going to need a new set of tires, when you're going to need to pay to replace the furnace, when you're going to need to do something that's going to give you, enable you to live. I used to use the term in less, creature comfort than someone in a modern prison. If the air conditioning doesn't work and you live in the South, it's probably not going to get, a lot of sleep if your air conditioning doesn't work. And I know some people are tough and they've acclimated. I'm not one of those people. But I think you get the sense of what I'm talking about. The emergencies are true emergencies. It's not iPads or trips or anything like that. That's a different fun. This is I can't get to work and I can't function as a human being, because my refrigerator's out and I can't store food, stuff like that. That's a true emergency. So that's what the fund's for. I would start, and again, this is just me. You have to decide for yourself, but I would start as soon as possible, even if it's $5 a pay. Just try to create some kind of a reserve. Just that mental, that kind of mental boost you'll get in, it's $5 a pay, it's $10 a month in a year. Yeah, it's only like $120, but it's still $120 you didn't have. You kind of get a mental boost from that. That's my sense of it. But again, everybody has to make their own determination. Let me check time here. I'm at 9:15. I think we're good here. Student loans, a simple answer. Yes, you need to pay them. No, you can't get rid of them. Realize it's a single line item in your financial world, but one with big, nasty, pointy teeth, but just one. There are experts, and Phi Alpha Delta brought some people in to talk about that at the last convention. There are people who really know this stuff, and they're out there, and I encourage you to avail yourself of them if you can, because some of this stuff gets very technical, and there's no one short answer. The things I want you to be aware of, there are programs that can help you. You might be able to qualify for lower payments or other adjustments. Student loan forgiveness, depending on the mechanism now, may not be the salvation it appears to be. In certain circumstances, the debt forgiveness may be subject to ordinary income tax. Just be aware. If you consolidate with a federal loan with a private loan, again, you no longer have a federal loan, and you can't take advantage of the the options you have under a federal program. I know that seems straightforward, but there were people that were not realizing that the federal loan is paid off when consolidated. It now is a private loan. Insurance. Life insurance is a tool to protect your family's future if you die. It's not a savings or an investment vehicle. Buy term if you need it. Take what your employer is offering. Beyond that, I don't want to get too far into it, but just I joke about the SNL floor wax skit because there was a skit on Saturday Night Live years ago where they were, I think it was Dan Aykroyd and Jane Curtin, where they had a bottle of something, they were spraying it on the floor, and she was going, "It's a floor wax." He was putting it on ice cream and saying, "It's a dessert topping." That's how different I find investment vehicles versus insurance vehicles. Again, that's my personal interpretation. Insurance is a tool. Find somebody that wants to give you the best tool for the job. There are really good insurance agents out there that understand a lot of things, and they can help you understand and protect certain risks. And those are the ones you want. You want people who can answer your questions and aren't looking to just sell you on something. Renters, homeowners, it's necessary. I always look at an insurance policy and try to figure out how they're not going to pay me. So I try to figure out, I've got earthquake insurance in Pennsylvania because we had one earthquake here. Nobody's sure if it's due to the fracking or not, but I'm not going to take the risk. If it's available to me, I'm going to pay for the earthquake insurance because it's, those that know me know I'm a little risk adverse. But we also have mine subsidence here because we have a lot of coal mines. And if you don't have mine subsidence insurance and your house falls into a mine that collapses, your insurance doesn't cover it unless you have mine subsidence insurance. So look for the specific aspects of your area that apply to your insurance policies for homeowners and renters insurance. Inland marine policy, if you can get it, use this instead of putting riders on your homeowner's policy. For example, engagement, wedding rings, things like that. Expensive watches. If you get one stolen, the claim is against that policy. If it's a rider on your homeowners, then you're claiming against your homeowners, and the number of dings you have on your homeowner's insurance goes to your rates and ability to insure. So you don't want to confuse those. Again, that's confusing two different purposes for insurance. Health insurance, we talked about escrowing your deductible, out-of-pocket maximums, what is and is not covered. leverage, qualified plans where you can. That would be your HSAs and such. Again, talk to your advisor, your accountant about, your individual circumstance, but generally they're definitely worth looking into. Beware of balanced billing. This is a concept where essentially I believe it only happens in out-of-network, but don't quote me. I'll give you my understanding. I'd encourage you to look this up. You go to an out-of-network hospital for something, the network will only pay for a certain amount of the out-of-network. Then the hospital comes back to you for what your insurance company didn't pay. And you're sitting there thinking, well, wait, my insurance company is supposed to negotiate these things, and now their hospital is coming out and billing you for the remainder. So that's out there, and it's a scary thing. There is some legislation out there to deal with this, but it doesn't deal with it entirely. Just understand that the health insurance thing it's not as clear as just having a policy. There are some serious idiosyncrasies to this that you have to read up on when you get your benefits packages, or when you try to go on the exchange. You have to know what's covered and what's not, and where you'll be covered. This has become super complicated, and it's out there, and I don't want people to not be aware of just how financially damaging. And I know when it comes to health, that may be the last thing you're thinking of, but the amount you're in debt, the amount you owe will affect your health, I guarantee it. So they are in some ways inextricably intertwined. Credit score. You need a good credit score. Background checks are a requirement. They want to know if you're a mark. If somebody can basically, if you're over your head in debt and somebody comes up to you and asks you to do something and they'll give you some money, they see, the intelligence community and those who are doing background checks for top secret clearances will want to know if you're vulnerable. Time and timely payment are the only remedy. If someone says they can fix your report and the information on your report is correct, well, I think as an attorney, you know what happens if you say something isn't correct that is correct, or you say something that isn't true. I won't put the label on it, but I'd say be super, super careful of somebody that says, hey, it's okay you paid that late, we can find a way around it. I don't encourage doing things like that. But just start now. It'll take time, but you'll grind on it, pay on time, and nothing will happen. Suddenly 2 years later, you'll see a big pop. It doesn't just increase by points. It takes time. So, but you want to have a good credit score for a lot of reasons. And a lot of your employers are going to do background checks that include credit scores. Every one of mine has. The bar will do it. It's important that you pay attention to your credit score. And I'd encourage you to subscribe, or a lot of credit cards now have a credit score monitoring function. But if you haven't run your own report, it's best to run one and see if there's anything on there you want to know long before you have to apply for the bar if you got to clean something up that's incorrect too. Cars and houses don't lease. Don't lease a car. It's a long-term rental that forces you to buy another car when it's over, or buy the one you have at a ridiculously high price. If any of you are taking secured transactions and certain courses in the UCC, you'll understand why that price has to be so high. Buy the least amount of car necessary, buy it used, and run it into the ground. Now, I know I'm really channeling your grandparents here, but man, that is the answer. Understand the actual cost of ownership. Once that BMW is out of warranty and out of its maintenance program, you will be shocked how much it costs just to replace an oil filter on high-end cars. That is where the money is made, in the maintenance. And it's funny because I actually was looking at a used one, because even great cars used. It's kind of I think it's kind of cool. And I found one that was a nice foreign car, and I called the local repair guy that I knew, and I asked him, I said, hey, can you help me with this? He said, yeah, I can repair it, but the parts are going to kill me too, because I have to source the parts. And so even if you have a good mechanic, the parts will get you too. So I'd encourage you to understand that the money is really made on the maintenance, and the higher end cars are very expensive to maintain. And that may be, a check you don't want to cut. And that's a corner you really can't cut. It's better to have a well-maintained, cheaper car that gets you to work than the one you can't afford to maintain and doesn't get you there. That's just kind of how I look at it. Houses, this is one I kind of want to, this is an idol I really want to smack around a little bit. It's not wrong to rent. Home ownership may not be the smart goal for you. I put it best you break even as a question mark. Over time, with taxes, house repairs, and all this, in some areas, the best you may do over time is break even with a massive increase in the value of the home. You have to make the decision to buy based on a number of factors, and it has to be the right thing for you. So I don't have a blanket encouraging statement on buying a house. It can be the smart thing to do, and when it is, it will benefit you. But don't be afraid. I mean, rent's kind of freedom. You know, you can pick up and go. If you find a job in another city, you don't have to worry about trying to sell a house. If they say, hey, you got to be here in 2 weeks, and it's your dream job. Always building a margin of safety. When you buy a house, I would take what you think you can afford, and I'd take 20% off it. That's me. I like 20% as a round number. This stuff's going to come up. When you buy the house and you think you have the money to afford it, you're going to need another 20% most likely. It's an expensive proposition, so I encourage that. Spouses, all right, what is your problem, Dan? I talked about this earlier. Money management is not a reflection of character. I have Churchill and Jefferson on here because these are two people who are significant historical figures. And again, I understand that in some sense there could be some controversy, and I'll do my best to expand this list to add some additional people just because I like to list this here. But I really think it indicates that money management, the inability to manage your money, is not a reflection of poor character. And I don't think you should look at your spouse in that way if they are not good at managing money. But you do need to know what's going on and you need to have a plan. And I would encourage you, and you're going to have one shot at this, and as a mediator, I'll tell you this. Before you get married, or even if you are married and you have to talk about this, I think what you tell the person is, look, here's a copy of my credit report, and hand them your credit report and say, I would like you to give me a copy of yours. I don't care what's on it, but I need to know where we are, and I need to know where we're going. And I think we both want to make progress, and I promise, and you have to keep this promise, because once you violate it, you're not going to be able to make the forward progress you need to. But you have to not judge them based on what's on there, and you need to come up with a plan to move forward. And if you can do that, I think you'll be okay. But it's important that you talk about it. You really need to have a plan. Second thing, the divorce is known, it's demonstrated to be the biggest, most effective destroyer of wealth, and there's a whole bunch of circumstances that lead to that. But if you can avoid making money one of those things that precipitates not even a divorce, but a disagreement that wasn't necessary, why wouldn't you? It's stressful enough juggling jobs and everything we have to deal with. If you can get organized on this one important thing, it'll be a big help. I have a number of slides in here that I added. I've only got 5 minutes, actually 3 minutes left here. This was targeted at thinking about your practice. Andrew, I don't know how much time we have. Is this going to cut off? Do we know a hard cutoff at 9:30?
It's not a hard cutoff. We can end it, being that we started a few minutes late, too.
Okay. So I'm going to try to breeze through these slides. If anybody has to jump off, I thank you for holding on as long as you have. And please feel free to give us whatever feedback you can. I know this might have not has been as smooth as we all would have liked it, but we really appreciate you joining us for this first one. So I'll kind of move into this one. The goal in life for this kind of thing is saying no. And what do I mean by that? When it comes to money, we want to sell as little time for as much money as possible. This is one of my professors at Duquesne. You need to know when to be able to say no. Do you feel like you can step away from a practice for a weekend or your job for a weekend, let alone an afternoon? If not, it kind of, you get to this point where it ends up owning you, and you're trying to figure out where that balance is. And balance is, it's a big concept these days, but nobody really has a good approach to it. So these slides are more geared at people who are looking to open their own practice. So I'm citing the E-Myth Revisited, which if you haven't read and you're running a business or a practice, it's really fascinating. If your business depends on you, you don't own a business, you have a job. And the worst job in the world because you're working for a lunatic, which is essentially yourself. At some point, your job is not going to be the priority in your life. As much as you want to believe it, something's going to come up. It's going to be your family. It's going to be health, friends, hobbies you love, volunteer work, things that really drive you. if you don't know how and when you can, or even if you can, step away from your job or adjust your hours, you will burn out because you will be trapped. I joke about this. In Excel, find freedom. Do you know, other than for purposes of your tax return, if your business is actually profitable? Overhead, it's the unseen hand that kills. Do you need an office? Do you need an assistant? Do you really need, start with the least amount of overhead you can. Do you know what every hour is going to cost you? In a lot of cases, we really don't know what the cost of doing business is. What unknowns still need to be factored into your billing rate? What gives you an oblique moment every year? I forgot to factor in that cost, and you're writing a big check you weren't ready for. Is each job costing you more money than it's making you? Do you know what your margin is on each job? Or are you in a position that you need to take the next job just to keep the cash flow going so you can keep the lights on? And again, back to whether you can step away. Almost every good business, in my opinion, and I know a lot of people will disagree with me, and that's why I'm saying almost, it can be understood in the back of an envelope. Your hourly rate should be a product of all cost operating your practice with a reasonable margin and adjusted for the market rate so you can remain competitive. Don't compete on price. You'll lose in the long run, if not the short run. Be the best value proposition. And again, all of this is subject to the applicable ethics rules, and there are some in every state with regard to billing. And again, this is all from a project management accounting standpoint. I've not vetted this portion for legal ethics. It's just some concepts I wanted you to think about. The problem is time. We spend a lot of time we don't charge, and in the beginning that's okay. But time is really our inventory. You don't have inventory, you have time. So you have to watch, how much lost time do you have on every case? If you're taking new ones all the time, are you spending more time, educating yourself than you are billing? And again, that may not be a bad thing, but you want to be aware of it. Contingency fee cases, essentially you're financing that. If you haven't, the best way to go through this is to read a civil action, which is a terrifying tale of many things, including poor money management. These types of practices require a lot of control over overhead because, they can take years to come to fruition for judgments. So I like this quote. It was Richard Pryor once got this manager, and this manager was talking about all the wonderful things they were going to do over the course of his career. And Pryor being, I think Pryor was a pretty smart guy. He said, that's great, but what are we going to do on Monday? Meaning, what do I do next, man? This pie in the sky plans are great, but what do I need to do? And I'm quoting Magnum here. I'm not sure why. Forgive me, I should have vetted this one a little better. Here's the analytical method. Spend some time now and get a decent bookkeeper and or account. They're really not as expensive as you would think, and they can be a big help. Each month, quarter, and year, look at the total expenses and determine what your practice really costs you to operate. Once you have a good idea what your practice costs, determine how many hours you reasonably want to work in a year that are productive. Of course, you might and can work more, but that should only generate upside. Divide the cost of your practice by those hours. This is the cost of your productive time. Again, this is not a specific accounting rule. This is not a specific ethics rule. This is just me saying on the back of an envelope, can you figure out whether what you're doing is profitable? Is it making you money? Because if it's not, it better be bringing you joy, which may happen. As I mentioned, you can't operate at 100% capacity 100% of the time. Eventually, you're going to break. Stress is as big a killer as anything else. You can kind of choose when the stress is going to hit you sometimes. If you do some work now, you can avoid some later. Another Jim Winder quote, life is a way of deloading you. Deloading in the exercise concept is you build up, and then you take, a light week, to deload and let your body recover. Sometimes life tells you, nope, it's time, you're going to recover, whether it's an illness or something like that. Your stress will build up and you will end up in a position where you have to take some time. Good data about your finances enables you to do better decision making for both you and your clients. One thing to note, I didn't say control, but you can't control everything or all the variables, but you can account for what might happen that you cannot predict by knowing as much as you can about your current circumstances and planning accordingly. I'm sorry for going through those last 4 slides. I hope there was some benefit in that, but that's the end of my slide deck. Again, I hope that was helpful. I suppose we can open it up to any questions if we still have people who have been kind enough to bear with